Did you know that millions of Americans are drowning in debt? It's a staggering number that continues to grow each year. Many people find themselves in this situation due to unexpected expenses, medical bills, or simply living beyond their means. The stress and anxiety that come with mounting debt can be overwhelming, affecting not just your financial health but your overall well-being. It's a scary statistic, but it highlights a crucial point. Borrowing money is a big deal. When you take out a loan, you're making a commitment that can impact your life for years to come. It's not just about getting the money you need right now, it's about understanding the long-term implications of that decision. Before you sign on the dotted line, you need to understand what you're getting into. This means reading the fine print, asking questions, and making sure you fully comprehend the terms of the loan. Many people rush through this process, eager to get the funds they need, but this can lead to serious problems down the road. One wrong move can have serious consequences for your financial future. Missing a payment or defaulting on a loan can lead to a lower credit score, making it harder to borrow money in the future. In extreme cases, it can even result in losing your home or other assets. That's why it's essential to educate yourself about loans. Understanding the different types of loans available, their terms, and their potential impact on your finances is crucial. This knowledge can help you make informed decisions and avoid common pitfalls. There are different types of loans, each with its own set of rules, risks, and rewards. For example, a mortgage is a long-term loan used to buy a home, while a personal loan might be used for smaller, short-term needs. Each type of loan has its own interest rates, repayment terms, and eligibility requirements. Knowing the difference between secured and unsecured loans is a good place to start. Secured loans are backed by collateral such as a house or car, which can be seized if you fail to repay the loan. Unsecured loans, on the other hand, do not require collateral but often come with higher interest rates. Understanding these differences can help you choose the right loan for your needs and avoid unnecessary risks. Let's break down these two common loan types. A secured loan requires collateral. This means you're pledging something you own, like your house or car, as security for the loan. If you can't repay the loan, the lender can take possession of your collateral. On the other hand, an unsecured loan doesn't require collateral. These loans are often based on your creditworthiness, meaning your credit score and history play a big role. Lenders see unsecured loans as riskier, so they typically come with higher interest rates. Choosing between a secured and unsecured loan can be tough. It's a decision that requires careful consideration of your financial situation, goals, and risk tolerance. Each type of loan has its own set of advantages and disadvantages, and understanding these can help you make an informed choice. It's like choosing between an apple and an orange. Both are fruits, but they offer different flavors and benefits. Similarly, secured and unsecured loans serve the same purpose of providing you with funds, but they come with different terms and conditions that can significantly impact your financial health. Secured loans often come with lower interest rates because lenders have some security if you default. This security usually comes in the form of collateral, such as your home or car. Because the lender has a claim on your asset, they are more willing to offer favorable terms, making secured loans an attractive option for those looking to save on interest costs. However, they put your assets at risk. If you fail to make your loan payments, the lender has the right to seize your collateral. This means that your home, car, or other valuable assets could be taken away, which can be a significant risk if your financial situation changes unexpectedly. If you lose your job or face unexpected expenses, you could lose your home or car. This is a serious consideration, especially in uncertain economic times. The stress of potentially losing your assets can weigh heavily on your mind, making it crucial to assess your ability to repay the loan under various scenarios. Unsecured loans might seem less risky because you're not putting up collateral. These loans are based on your creditworthiness and income, which means that your assets are not directly at risk. This can provide peace of mind, knowing that your home or car won't be taken away if you default. But remember, the higher interest rates can make them more expensive in the long run. Lenders charge higher rates on unsecured loans to compensate for the increased risk of not having collateral. This means that while you might feel safer not putting up your assets, you could end up paying significantly more in interest over the life of the loan. Plus, defaulting on an unsecured loan can seriously damage your credit score. A poor credit score can affect your ability to obtain future loans, secure housing, or even get a job. It's essential to consider the long-term implications of your loan choice on your overall financial health. Weighing your options carefully and seeking advice from financial professionals can help you make the best decision for your unique situation. Let's take a closer look at secured loans. Common examples include mortgages, auto loans, and home equity loans. These loans are often used for significant purchases like buying a house or a car. Secured loans typically have longer repayment terms, which can make monthly payments more manageable. However, it's essential to factor in the total interest paid over the life of the loan. Section 5. Unsecured loans, what you need to know. Now let's explore unsecured loans in more detail. Common types include personal loans, student loans, and credit cards. These loans are often used for smaller expenses like debt consolidation, home improvements, or unexpected medical bills. Unsecured loans typically have shorter repayment terms and higher interest rates compared to secured loans. It's crucial to have a solid plan to repay the loan on time to avoid falling into a debt trap. Section 6. Choosing wisely, a formula for success. In this section, we will delve into the crucial steps you need to take to ensure you make the best financial decisions when it comes to choosing a loan. Whether you're looking to buy a house, finance a car, or fund your education, making the right choice can save you a lot of stress and money in the long run. So, how do you decide which type of loan is right for you? The process can seem overwhelming, but breaking it down into manageable steps can make it much easier. Let's explore a simple yet effective formula to guide your decision-making process. Here's a simple formula to guide your decision. 1. Assess your needs. This is the foundational step where you identify the purpose of the loan. Are you planning to renovate your home, purchase a new vehicle, or perhaps cover educational expenses? Clearly defining your needs will help you narrow down the type of loan that best suits your situation. What do you need the loan for? This question might seem straightforward, but it's essential to be specific. For instance, if you're looking to renovate your home, consider the scope of the project and the estimated costs. If it's for a car, think about the make and model, and if it's for education, factor in tuition, books, and other related expenses. How much money do you need? Determining the exact amount is crucial. Overestimating can lead to unnecessary debt, while underestimating might leave you short of funds. Take the time to calculate the total amount required, including any additional costs that might arise. 2. Evaluate your financial situation. This involves a thorough review of your current financial health. Start by checking your credit score, as it plays a significant role in the loan approval process and the interest rates you'll be offered. A higher credit score can open doors to better loan terms. Can you afford the monthly payments? This is a critical question. Review your monthly income and expenses to determine if you can comfortably manage the loan repayments. It's important to ensure that the loan won't strain your finances or lead to financial hardship. And 3. Consider the risks and benefits. Every loan comes with its own set of advantages and potential drawbacks. Weigh the pros and cons carefully. For instance, while a secured loan might offer lower interest rates, it requires collateral, which means you risk losing your asset if you default. Are you comfortable putting up collateral? This is a significant consideration, especially for secured loans. Collateral can be anything of value, such as your home or car. Ensure you're fully aware of the implications before proceeding. Can you handle a higher interest rate? Unsecured loans typically come with higher interest rates due to the increased risk for lenders. Assess whether your budget can accommodate these higher payments without causing financial strain. By carefully considering these factors, you can make an informed decision that aligns with your financial goals. Remember, taking the time to evaluate your needs, financial situation, and the risks involved can lead to a more secure and beneficial loan experience. Making the right choice now can pave the way for a brighter financial future. Section 7. The bottom line, knowledge is power. Remember, knowledge is your best defense against bad debt. Before you take out any loan, take the time to understand the terms and conditions. Compare interest rates, fees, and repayment terms from different lenders. Don't be afraid to ask questions and negotiate for better terms. Your financial well-being is worth the effort. Section 8. Share your story. Let's learn together. Have you ever faced a tough decision between a secured and unsecured loan? What factors influenced your choice? Share your experiences and insights in the comments below. Let's learn from each other and make smarter financial decisions together.